back. If you've been listening in for a while now, then you'll know that I love all things property. And the reason for that is that the property strategy and building a property business is what has enabled myself and my husband to become financially independent many years ago. And so today's episode is going to concentrate on the third of a series of financial calculations that I'm going through with you. So to help you understand how to see if a deal stacks up in the early stages of working out your calculation. So today's episode is all about, will a property wash its face? And the term wash its face is commonly used in the property industry to describe or determine whether a property will look after itself in the context of the amount of rent coming in versus the amount of expenses going out. And ideally, you don't just want it to look after itself, you want it to have a decent return as well, decent cash flow, which is what I spoke about on the previous episode. So, unless you are investing purely for capital growth, then this is particularly important. However, as I've said before, it's to me, it's vital to have that cushion of cash flow in case anything goes south, either in terms of a tenant disappearing and not paying, or interest rates going up, or unexpected repairs to the property, etc., etc., etc. You name it, you need that cushion so that you can be kind of considering that this property is going to be safe for you. So this formula is a very basic formula designed to help you work out whether a property is even worth your time going to look at. Okay, so I hope that it works out well for you. You might want to grab a pen and paper or however you take notes again, because we're going to run through some calculations. And so you're going to need to take notes or come back and listen to this again if you're out driving the car or running or washing up or whatever you're doing when you're listening to me. So we're going to take the same property again as we took previously in the last episode, just to make things consistent and easier for you to kind of grasp. We're going to take the one which is worth £150,000. So let's say you're looking at a property worth that figure. So we're going to start with the property value being 150,000, and then we're going to work out the amount of mortgage you're going to raise. And we're going to go for the full whack of 75% loan to value. And that's pretty much, you can obtain higher than that here and there occasionally, but most people, when they buying properties in this day and age, they go for about 75% loan to value as the highest amount. We're then going to multiply this number by the interest rate that you'll be paying, and that will get you an annual mortgage figure. We're going to then divide that by 12 to get a monthly mortgage figure. And then you're going to multiply that figure by what's called the rental coverage, which is the number that the mortgage lender wants to see over and above what the mortgage payment's going to be, just to make sure that the rent's going to cover any unforeseen eventualities like I've just described. And this figure is usually between 125 and 145% of the mortgage amount. Okay, so we're going to see what this looks like. We're going to tell you what to write down so you can work it out for yourself, and then you can use these calculations for your own purposes. So let's take the property value first, which of course is £150,000. We're going to multiply that by the amount of mortgage you're going to borrow. And in this instance, it's 75% of the value. So you're going to multiply 150,000. You're going to multiply that by 0.75, which is going to give you the figure, which is 75% of that value. And that works out at £112,500, £112,500. Okay. Then we're going to multiply that by the interest rate that you're going to be given. And in this instance, we're going to say 4.5%. So the calculation there is 112,500 multiplied by 0.045. Okay, and that represents the interest rate that you're going to be paying. So that gives you an annual mortgage payment figure of £5,062. We're going to divide that by 12 to get the monthly figure. That monthly figure is around about £422. All right. Then you're going to use the rental coverage that you need from the lender, and in this instance we're going to use 125%. Okay, you can do 145 if you want to, entirely up to you, but for this purpose we're using 125%. And so what you need to do is you need to take the £422, which was your monthly mortgage payment, and you need to multiply that by 1.25, which gives you that 125% rental coverage that the lender wants to see to make sure that you can afford everything. Okay, so that ends up being £527 a month. That's what the lender wants to see in terms of a minimum rent coming in from the property to see and check that they are happy to lend on that basis. So if you've got a rent of £900 a month coming in, which is the example we based it on in the last episode, you'll see that this is more than enough to cover the requirements of the lender and certainly the mortgage payments. And it's a great place to start when you're considering a property. That gives you it gives you around about £370 a month excess over and above what the lender wants to see, which is a really nice, comfortable cushion in terms of the rent coming in versus the mortgage going out. And in fact, it's more like over £400 a month without the rental coverage. Okay, so you obviously, when you're considering a property of this nature, you also have the potential of the increase in value of the property over time as well. So that if the property increases over time in value and you don't change the mortgage, then the mortgage loan to value will become less than 75%. Okay, so if it increases year on year on year and you keep the mortgage the same, it will basically end up eroding the debt level that you have against the property value, which is really quite cool. And that's exactly what's happened for us over all these years. So it can obviously also be the case that the property prices go down. So you can't always count on the market going up, and that's why it's important to have this buffer. Yeah, the buffer of cash flow. So back in 2008, when the credit crunch hit, and essentially a lot of our equity was wiped out across our portfolio, we didn't really care because we weren't selling anything. We had a decent level of cash flow, and more than enough cash flow to keep the portfolio going and to be able to afford everything whilst that equity level had gone down. And that's only because we'd made sure that we had that the cash flow built in from the word go, so that it didn't really matter what happened in terms of the equity in the properties. Obviously that all came back again and then some. So we now have a very well cash flowing and healthy equity level in our portfolio because we've ridden the waves and we've held it over the course of time to be able to iron out all those kind of issues that can crop up when you hold property and you run it as a business. So that is the wash its face calculation. Now there is another calculation on this basis, and we're going to call it the reverse wash its face calculation, meaning let's instead take a rental amount that you can expect to achieve and see how much or how high a property value you can go to when you're doing your search, rather than basing it on the property value and then figuring out what the rent's going to be and how much you need. So we're going to reverse it. We're going to start off with the rent rather than the property value. Okay. So this basically allows you to determine the maximum property value that you can go to when considering the amount of rent that you're going to achieve. And this helps in areas where the property prices are higher as against the rent. Okay, so let's take that £900 a month rent example again and analyse it. So firstly, you're going to take the monthly rental figure and you're going to divide it by that lender's rental coverage rate. It's also called an ICR, or interest coverage ratio. Okay, that's the same principle as I've just shared with you about how much the lender wants to see over and above the monthly mortgage. So you're going to take your rent and you're going to divide it by that coverage rate. Next, you're then going to multiply it by 12 to get an annual figure, to get an annual mortgage interest figure. Then you're going to divide that number by the interest rate that you're paying. And then finally, you're going to divide it again by the loan to value of the mortgage that you're able to get, i.e. the 75% loan to value mortgage. You may have to listen to this a few times just to really let it sink in if some of these terms are confusing or you've never come across them again, but it's definitely going to be worth it for you. So here's that worked example. We're going to take the monthly rent, which we're saying is £900 a month, and you're going to divide that by the rental coverage amount. So we're going to divide that by 1.25, which is that 125% rental coverage. Okay, so 900 divided by 1.25. That gives you a figure of £720. You're then going to multiply that by 12 to get your annual mortgage figure, because the 720 is the monthly mortgage figure. And if you do that, you multiply 720 by 12, you get £8,640. That's your annual mortgage interest figure. You can then divide that by the interest rate, which remember was 4.5%. So you're going to take 8,640, divide it by 0.045, which is the interest rate of 4.5%. And that gives you a maximum mortgage amount that you can take out of £192,000. Crazy, right? You're then going to divide that figure by the loan to value that you can have against the property value. And so you're going to divide the 192,000 by 0.75, that's the 75% value, loan against the value of the property. And that gives you a total property value of £256,000. So that is the maximum property value that you could purchase with a rent of £900 based on all those figures. Okay. Now, you'll see here that that's pretty astonishing, considering that £900 a month is not a huge amount against the 256,000 property value. It always fairly astounds me that, based on the traditional method of buying a property, the rate of return on this type of deal would then be very low. If you go back to the last episode and you put those figures in instead, it's like not great. Okay. However, you may think, yeah, I'm going to discount that, not going to bother with it. But you may see a different strategy that you can work with it to, if it's in a particularly nice area and it's a really good property, and you might be able to turn it into an HMO, which is a house of multiple occupation, where you rent out the rooms, or you might do a holiday let or serviced accommodation, something like that. If you know what you're doing, this type of property can still work, especially in terms of potentially the capital appreciation, the capital growth in that area. So there are lots of different reasons why you may go for something like that. But in the first instance, to me, that doesn't stack up particularly well. But, it's all about learning, understanding what you're getting into, and knowing your numbers. Now, one worthwhile point to note is working out the numbers to take account of any cost of borrowing that you have, extra cost of borrowing. So what I mean is, if you're releasing funds out of your own home, or you're borrowing from any other source for the deposit, for example, a joint venture partner, or any other type of loan that you're getting out for the deposit and even for the refurbishment works, this cost of borrowing also needs to be taken into account when you're working out your return, the true rate of return. So, yeah, that's a whole other ball game, but just need to take that sort of thing into consideration. So I hope that you can now see clearly the basic yet vital components to assessing whether a property is going to be financially viable in the first place, i.e. it's going to wash its face or not. I cannot emphasize this point enough, that it's super, super important. If you practice these formulas again and again on different examples, take some properties that you're taking off Rightmove or Zoopla, or some agents' information that you're getting, and you practice, it soon becomes second nature and can really help you to understand whether a property deal is, worth looking into. And you can apply them wherever you look, whichever country, whichever area, you can apply these principles. So they are pretty universal, I'd say. And before too long, the great thing is that you actually start to become good at spotting potentially really good deals before you've even worked them out, because you get good at these numbers. So I hope you have as much fun as I do crunching numbers. As you can see, this is one of my favourite things to do. Crunching numbers, researching, the actual refurbishment of a property, talking to tenants, all sorts of things. But these ones, it's the fun, fun baseline of the exercise. So start practicing. If it's of interest to you, get practicing, get your numbers down on paper. And of course, if you need any help, you know where I am. Until next time, I'll see you then.